Greetings, comrades. With the lower of cost or NRV rule, if we have a lower NRV than our cost, then an inventory write-down is required. So let's have a look at this example here. We've bought some vases for $100 each. There's our cost. The store person's unloaded them and we've got some damage and we're going to now sell them for $80 each. That's our RV, a realisable value. To give the sales staff some incentive, we're going to give them a $10 commission. So that's a selling cost. So therefore, we're going to, from this, record a IWD in the GJ. We're going to identify the effects on the reports, and we're just going to complete an income statement extract. So given we need to do some calculations here, best to show our workings. Always useful to start with a formula if applicable, and it certainly is in this case. So our NRV formula is our realisable value, $80, minus any selling, marketing or distribution costs. We don't have any marketing or distribution costs, but we certainly have a selling cost right here with that $10 commission. So therefore our $80 RV minus our selling cost gives us an NRV of $70. Again, the rule here needs to be emphasised, the lower of cost or NRV. Given our cost is $100, established up here, this means that the inventory write-down will come into play because our cost, $100 minus our NRV, gives us a $30 inventory write-down per unit, and there were 6 units affected. So the total value of our inventory write-down, 6 times 30 is $180. Now the accrual basis assumption requires us to record a loss as soon as it's anticipated, if it's measurable, and it certainly is in this case. So we need to debit our inventory write-down account. That's an expense. It's an expense because there's a decrease in assets in terms of the impact of value of our inventory, and there's also a decrease in our OE as a result of the expense, which reduces profit. Our asset goes down, so therefore we need a credit to our inventory account for 180, so our debits equal our credits. And if we're asked to do a narration, we always, whenever we have narrations with an inventory item, we need to identify the type of inventory, how many units affected, and we certainly need to cite our source doc number. Now, when we're asked to identify the effect of an adjustment on reports, let's just be mindful that we have 3 reports in accounting. So if you're not given a table, put this one in. Cash flow, income statement, and the 3 components of your balance sheet. Or alternatively, you might be given something that looks like this. Don't neglect the cash flow. We still need to state that there's no effect. This is a non-cash transaction, so we don't ignore the cash flow. We just simply state that there's no effect on it. Now, in terms of the income statement, as I said before, the inventory write-down is an expense, which is increasing, so therefore that will have a negative impact on your profit by $180. In the balance sheet, A equals L plus OE. Our assets are going down by a ton 80 due to the loss in value of our inventory, the write-down. We still need to state that there's no effect on our liabilities to support the accounting equation, and our OE has gone down by 180 due to that expense that we've talked about in the income statement. With your balance sheet, just make sure that A still equals L plus OE, so therefore the effect in this case needs to be matched on both sides of your accounting equation. Now, in terms of the impact on the income statement, we just squeeze this between our GP and our adjusted GP. Yes, it's an expense, but it's a trading expense, so that's why we put it in the upper part of our income statement to determine our adjusted GP. So our GP is simply our revenue less our our trading revenue less our trading expenses, and then we factor in inventory gains, inventory losses, inventory write-downs to work out our adjusted GP. Then we add our other revenue and our non-trading expenses.